Inflation refers to the rate at which the general level of prices for goods and services in an economy rises over time. It erodes the purchasing power of money and can impact various aspects of the economy and personal finances. Here are some important things to know about inflation. 1. Causes of inflation. Inflation can be caused by various factors, including demand pull inflation, which occurs when demand for goods and services exceeds supply, cost push inflation, which occurs when the cost of production increases and is passed on to consumers, and built-in inflation, which occurs when past inflation expectations influence future inflation. 2. Effects of inflation. Inflation can impact various aspects of the economy and personal finances. It erodes the purchasing power of money, reducing the amount of goods and services that can be bought with the same amount of money. It can also affect interest rates, wages, savings, investments, and borrowing costs, and may have implications for economic growth and stability. 3. Measures of inflation. Inflation is typically measured using various indexes, such as the Consumer Price Index, CPI, and the Producer Price Index, PPI, which track changes in the prices of a basket of goods and services over time. These indexes provide a measure of the average price change in the economy and are used to monitor and analyze inflation trends. 4. Impact on investments. Inflation can have implications for investments. Some investments, such as stocks and real estate, may provide a hedge against inflation as their prices may rise with inflation over the long term. However, inflation can erode the purchasing power of fixed income investments, such as bonds and cash, as their returns may not keep up with rising prices. Therefore, it's important to consider the impact of inflation when making investment decisions. 5. Strategies to manage inflation. There are several strategies that can be employed to manage the impact of inflation on personal finances. These include investing in assets that historically have shown resilience to inflation, such as stocks, real estate, and commodities, diversifying investments across different asset classes and regions, considering inflation-protected securities, such as Treasury inflation-protected securities, TIPS, and regularly reviewing and adjusting budgets, savings, and investment plans in light of inflationary trends. 6. Government and central bank responses to inflation. Governments and central banks often implement policies to manage inflation. These may include monetary policies, such as adjusting interest rates, open market operations, and reserve requirements, and fiscal policies, such as government spending, taxation, and regulation. These policies are aimed at influencing the supply and demand factors that drive inflation and maintaining price stability. 7. Inflation expectations. Inflation expectations, or the anticipated rate of inflation in the future, can impact economic behavior and outcomes. 7. When households and businesses expect higher inflation, it can affect their spending, saving, and investment decisions, as well as wage negotiations and borrowing costs. Central banks also closely monitor inflation expectations as they can influence actual inflation outcomes. In conclusion, understanding inflation and its impacts is important for managing personal finances, making investment decisions, and analyzing economic trends. Keeping abreast of inflation trends, government policies, and inflation expectations can help individuals and businesses make informed financial decisions in an inflationary environment. Hope you like this video. Please show your support by subscribe my channel. Thank you.